Welcome back to IRF 2018. Everyone is requested to kindly settle down so that we can start with our next sessions. The next panel discussion for today is on behind the scenes, what an entrepreneur, founder, CEO goes through in setting up a venture from scratch. I would request a moderator for the session, Mr. Shubhranshu, Pani, MT Retail Services and Stress Asset Management Group, SAMG JLL India, to kindly come on stage. Please welcome Mr. Shubhranshu, Pani with a huge round of applause. I would request Mr. Pranav, Desai, Director and CEO, Cleveland CycleWerks India, to kindly come on stage. He's one of the panelists. I would request Natasha, Shah, founder of the Nature's Company, to kindly come on stage. She's one of our panelists. I would request Mr. Nikhil, Ranjan, founder and MD, William Penn, to kindly come on stage. He's one of our panelists. I would request Mr. Sohrab, Sitaram, co-founder, Keventers, to kindly come on stage. He's one of our panelists. I would request Mr. Ashwin, Mocherla, co-founder of the ThickShake factory, to kindly come on stage. He's one of our panelists. I would request Mr. Sagar, Daryani, CEO and co-founder, Wow Momo, to kindly come on stage. He's one of our panelists. I would request Mr. Siddharth Bindra, MD, Biba, to kindly come on stage. He's one of our panelists. Please give a huge round of applause to our moderator, Mr. Shubhranshu, Pani, and the entire panel. Thank you.
Good afternoon, ladies and gentlemen. Sorry to keep you waiting. My name is Shubhranshu. I'm from JLL, and my retail journey with JLL Retail started when we started leasing our first shopping centers in the year 2000. And over the years, JLL has leased over 175 shopping centers across 90 cities. Some of the key shopping centers which you would have thought of would have been ground up, consulted with us, or leased by us. We continue to do this good work across the country. We have about 100 leasing agents and advisors who support developers. And one big part of that journey was retailers. And we went through the retail journey, having people start out from mom and pop stores or 1 or 2 stores to a large chain of stores, and we've been through the journey with most retailers. And I won't say that makes me competent because I've not done the mistakes, but maybe because I'm observant, I have lived that mistakes with lots of brands. Personally, I would have opened about 150 brands, starting from the first store to the 100th store, and also closed about 25, 30 brands. So that journey itself makes me watch out for things to do or not do when a brand comes and tells me to expand. But before I go and introduce the panelists or they introduce themselves, I just wanted to know how many of you are already in the entrepreneurial journey. If you can just raise your hands. How many of you are already in the entrepreneurial journey? That's about a fair spattering of it. And how many of you are thinking about, are you sitting on the fence thinking, okay, I also need to do that? A couple. And the rest of you are retailers or from other professions. How many of you are non-retailers here? Okay. So, interesting mix. This story and this journey of starting retail is a very different story for every person, every product, and every category which you will see. And what I'll do is I'll just do a round of session with everyone telling what their journey has been so far and a little bit about the brand. So you get the context of what they're going to tell. We'll start with Sagar, if you can tell us what your journey is, what your product is. Many of the audience may not know you well, so.
Well, if you really need to know us, you need to go and taste us. We're right here in the corner. Basically, we started Wow Momo 9 years ago. I was out of college, 21 years old. Began with only rupees 30,000 from a middle-class family. My dad's garage was my base kitchen. That's how it began. Why it began was, again, I was defocused. I was coming out of a breakup. Honest opinion. I mean, honest answer that I'm giving you.
That's not a startup problem.
Yeah. Yeah?
That is not a startup problem.
That's a lifestyle problem, you know. Every youth goes through it. So I focused my energies to the positives and I said, let's build a brand. I was pathetic with maths and numbers. So yeah, I was like, agar khud ka brand banana hai, to let's get going, and nothing better than food, you know, because food goes with the word of mouth. You like it, you go and tell your friends, they go and tell their friends. So we began Wow Momo, and the journey has been fabulous. I think we bootstrapped for the first 43 stores. So we saved money from 2 stores, opened 4, from 4 to 6, 6 to 8. Now, how do you start business with rupees 30,000? So we were a bit smart. In India, if you have to do a startup, you have to know how to do jugaad. So we did a shop-in-shop format where there's no flooring expenses, no ceiling expenses. So we opened our first kiosk inside Spencer's in Calcutta. We played it very smartly. I remember in those days, we did not even have money to print leaflets. So I would cut one piece of Momo into 4 parts and walk up to every customer wearing the Wow Momo t-shirt and telling him or her that we've started a new brand, please taste us and see. We believed in our product.
So is that where Starbucks copied the idea from? So when you go to Starbucks, they give you a new item. This is a new item. Can you please try?
I wouldn't say Starbucks copied it from us. I think it was something which was the need of the hour.
I'm just joking.
I think it was the need of the hour because I felt that if you believe in your product, I believe that if log ek piece hamare momo ka khayenge, they'll come and buy the entire plate. That's how we began. I remember in my initial days, I had to take sharing autos to go to my first destination. I could not afford a vehicle. So me and my co-founder, Binod, we would carry that jhola wala bags, momos in that, and take 2 autos to reach my destination in Calcutta. And while coming back, because one of the, the momos would be empty, it would be sold out, we would walk one way to save rupees 10. And that taught us that, as a startup, 1 rupee saved is 5 rupees earned. Right from there, today we are at, we have a fleet of 40 vehicles, 2,000 people working with us, 194 stores across 13 cities. So it has been a journey. I think it's been a dream come true, and currently we're living a dream.
Wow. Wow. That's brilliant. Ashwin, if I can just ask you next on what you think is your journey and what's your product so that people know you a little bit more.
Okay, right next to Wow Momos, there is one more store called the ThickShake Factory. So I don't know how many of you have tried it, but if not, please go and try it. So that's our brand, and we would like the product speak for itself. So we are a humble company started in 2013 based out of Hyderabad. So when we first started, it was co-founded by me and my brother Yashwant. So we both are MBA graduates, and I was still studying my MBA when we co-founded the company. So the aim was to bring special retailing of milkshakes to India, because the quality of milkshakes in India was very poor. I mean, it was always diluted because there was never a thick shake back in India when we wanted to start it up. So that's when we thought, okay, let's bring a more quality product, let us spend more on it, and let us just hope that customers would be able to pay that much amount for a premium. So that's how the journey started. We started with one store in Manjeera Mall in Hyderabad, and it was a very humble beginning with a bootstrap fund of around 18 lakh rupees, which went into advances, equipment, and the training and development and everything. And there were a couple of core values that we always envisioned when we first started. We always wanted to make the company scalable, and we always wanted to control the quality of the product. So that's the reason why, even though we didn't have one particular outlet even in existence, we backward integrated, which is not such a wise thing to do, but we did that because we knew that that would bring in a lot of value to the product. So that's how we were able to focus on our quality, the quality of the product that we give across every single city. Right now we are in 20 different cities. We have 90 outlets, and we are expanding much more than that. The dream is to be around 300 outlets by the end of 2019. And we would also want to look at other opportunities until, that is only after we establish ourselves as the premium milkshake or a thick shake brand in India. Once everybody gets to taste the product, that's when we would like to explore into multiple segments as well. But that's how the journey has been, and I'm very happy to have shared this journey as well.
Wow. Now Sagar. Sohrab, sorry. My apologies.
No problem. So, if you've been to ThickShake, I'm sure you have been to Keventers also. So primarily, Wow Momos, Keventers, ThickShake, you'll find them within the same vicinity in quite a few places. So, where Keventers, my journey began because I've actually been in the nightclub business. So I've always put in a lot of, I've both invested money in nightclub business and run the nightclub business. My background, actually, I come from the Taj Group, and I've worked with the Taj for about 7-8 years. So I was always fascinated by the nightclub business. I thought that was a business where you could really recover. The return on investment was very quick. But somewhere down the line, I found that the scalability was an issue, primarily in the nightclub business. So we invested in restaurants. So I've seen every part, right from the nightclub business to the restaurant business, both invested and run, to finally QSR. The journey of Keventers is a very old one. I don't know how many of you know, but Edward Keventers came to India and started Keventers in the year 1890s. That time, Keventers was, it became the Amul of India. In fact, it was manufacturing butter, ghee, everything. And India did not have the dairy technology. And it was bought over by the Dalmia family in the 1940s. They ran it till the 1960s. If you're familiar with Malcha Marg, that's where the factory of Keventers was. But it shut because of, well, some issues over there because Malcha Marg became a diplomatic zone. So from that time, we did not have Keventers. We finally, I was met by two young entrepreneurs, Agastya and Aman. Agastya, of course, came from the Dalmia background, and they met me. And we decided that we'll invest in the business and scale up the business. So we started this company in 2015 again. And till that time, there was no Keventers, but the name was there, of course. And in 2.5 years, we've grown the company. Today, we have around 250 plus outlets, and all this we've been able to do in about 2.5 years. And we're across 40 cities in India. That's my story.
Wow. 2.5 years and 250 outlets.
Oh, yeah. Yeah, we didn't start with 35,000 or 18 lakhs. We started with a lot more. So just, yeah, I wish we could have done that.
Yeah, Pranav, over to you.
Hi guys. So all these calories which have been added from this side. So if you want to burn these calories, we have 2 motorcycles standing outside. So that is from our side. It's Cleveland CycleWerks. It's a US brand, and it's been a 2.5 years journey when we started this venture in India. And unlike the other case studies, we were talking off late that this is a different industry. We are from automobile industry. It's a capital intensive. At the same time, it has a lot of challenges in terms of compliances to be passed for the product when we go to the agencies to get the license and certification, all this thing. So it has been a journey from that point onwards. And when I discuss the challenges, I would say only, I can recall the movie with the Vidya Balan starrer when she said that industry wants only 3 words, entertainment, entertainment, entertainment. In the same fashion, when we see the challenges for us, only 3 words, uncertainty, uncertainty, uncertainty. So when you pass through 2 years, which I have seen, a lot of things happen. I mean, there are so many challenges. You get into the product positioning, you face some issues there. The government stuck with us, the new norm, like recently in the February.
We'll come to the challenges later. If you just tell us where you are now in the journey, so that we'll come to that later.
So now we have reached to the stage where we got 2 bikes certified and ready to roll in the market. We have 10 stores coming up in India. We are in the phase of expanding dealership network across India. So all the major cities in southern region and western region we are tied up with for dealership, and we are look forward to go ahead. So it's been a journey, yes, and during the course probably can elaborate more on certain points.
Yeah, thank you. Natasha, over to you.
Hi, this is Natasha from the Nature's Company. The Nature's Company is into natural bath, beauty and wellness products. The brand is nearly a decade old, and we did have 9 stores, pan-India basis, 9 standalone stores, company-owned stores. But 4 years back, we moved base with, we moved out from our parent company, and that's when we decided to go completely online and e-commerce. And now the brand is available on their own company website, and the products are available on all major portals. So it's a different story for us here, from standalone stores to completely online. It's a different positioning that we have decided now, and that's where we are. Thank you.
Thank you. So we've got an online person as well, somebody who moved from offline to online. Interesting journey. So now, Nikhil, if you can hear a little bit more about what your journey is.
Sure. So we are relatively older compared to the younger lot over here in terms of the age of the business. So William Penn, The company that I started is 16 years old today. When we started off as a stationery store, very soon specialized in writing instruments or premium pens. And over the last 2 years, we have pivoted into accessories for men. So we are a store format. We are 31 stores across the country. You would have seen us at the airports. We're at prominent malls. And more recently into accessories and, of course, online. So that's a big, brief background about myself.
Yeah. Siddharth?
Yeah, I'm Siddharth Pindra. I'm the managing director of Biba. We're a women's ethnic wear brand. I think we also started off as a startup quite some time back. It's a business that my mother started from home. So I think it's been a fabulous journey. Personally, I still believe the journey is just beginning. And it's been a long journey from starting at home to being a wholesaler to actually creating a first women's ethnic wear brand. Started with a single category, moved to many categories. Also, I think introduced categories to the market in terms of kids wear, etc., etc. I think we were lucky to be at a time when retail was at a very nascent stage. So as a brand, we've had the opportunity of doing many, many firsts in the country, in the retail space. We're the first to do Bollywood merchandising, the first to start a shop-in-shop concept long back. And I think been lucky to have grown with the retail business all along the way. Thank you.
Thank you. And I must be happy and proud that I started your first few stores. I remember those days. We'll come to those problems when we're later. I think the next section, what we want to point out, maybe for those entrepreneurs or those who are in the retail business, is what are the problems more specifically about a product or a people, what the people face in an early stage, and maybe if the audience, if the panelists can bring out what are the mistakes you made or what not to do. I mean, maybe 2-3 points of what not to do or what mistakes. Siddharth, we'll start with you, for example. The early stage problems.
I mean, frankly, our early stage was just so full of opportunities. And I think still it is. So problems have been more operational. I think it's more personal how you...
I can share a problem I faced for you. For example, to get you your first store in a shopping center when you didn't have a retail store. The shopping centers were really skeptical. They didn't even know whether you could run a store. They didn't know what product you'll keep. And it took a lot of convincing. Took a lot of convincing. But what about people? Did people join you then?
No, I think it's a fair point. I think anything new that you do, and when you're the first person to do it, you need a lot of conviction in your idea. You've got to stay with your thought and the conviction. You will have resistance. We didn't get our first store. We didn't get our first shop-in-shop. Most people couldn't fathom the idea. I mean, first the idea of a branded salwar kameez itself was an alien idea. Moving on to a first shop or opening a first category or even making ethnic kids wear and running stores specifically on it. So I think most entrepreneurs will face a lot of resistance, a lot of problems. I think in the initial days, funding was always a problem. We'll
go to funding later, but otherwise, if you want to tell the audience, what are the 2 things they should not do when they start up in the first 3 or 5 years?
So I think focus on your on a very few things. Focus on a few things that is the core of the business and really drive it to execution to the way you've conceptualized it and thought about it. Because resources are limited and even mind space and energy is limited. And you've got to really come down to the few critical things that are really going to matter for the business and focus on that.
Yeah. Nikhil, you want to tell what are the problems you faced in the first 2-3 years and maybe what 2-3 things not to do?
So one of the most important challenges we had to face was about credibility. So, you know, back when we started, okay, we were, you know, at those days, a startup. We were selling, you know, premium writing instruments, and people always had their doubts on the format. So credibility, establishing credibility was one of our biggest challenge. And, you know, one of the few things that we did right at that time was to communicate both externally and internally. communicate with various people, right from customers to mall owners, that, to give us a chance to prove ourselves, and internally, which is as important as externally, because, sometimes you need to have people who believe in what you're doing and believe in the model that you have. So, communication.
But were you confident about the size of your store, for example, or were you confident where you wanted to be, and that will you be able to afford the rents and the deposits, etc.? Very confident of that?
Absolutely. So we started our first store in this format in 2004 in Forum, Bangalore, and it took off very well. So that gave us the confidence that we could replicate elsewhere in the country.
So do you think that is lucky that the first store was profitable, or?
I don't think there's anything called luck, right? Over a period of so many years, I think it's important to persevere. It's important to understand what the customer is doing and saying and make those course corrections and adapt. So I think all these are aspects that are very, very important in building a successful company over the last so many years. So I think all these elements have to come together. So what I'm talking about is probably the first challenges that we faced after we started our first.
It's interesting that you bring that course corrections, because what I want to hear from Natasha is you started off offline stores and then you moved online and you closed down offline. So what are the learnings, and I mean, what else can you share with us? Why online more preferred to offline, and you are saying you won't open offline anymore. So just a few bits.
Okay, so let me go back to the days when we had offline store, and this was our first store. We were opening at Select City Mall in Delhi, and I was in my mid-20s then, and when I went to, with no retail background, we were from FMCG mass manufacturing company, and with jumping right into retail, luxury retail was a challenge itself. So when we went to ask for a store there, we were like, they said, is your dad or is your husband going to join you for the meeting? And I was like, no, this is my baby and this is where I'm going to make all the decisions. So as a woman entrepreneur, as a young girl, I think that was the first challenge that I faced, which was a personal challenge. And the strategic positions that you should take in a mall, the right place, the ground floor, right in the top, so we were sent to the second floor, being a new brand, So these...
That must have been a lot to do with us, real estate people, because we felt we had to zone the mall and bring clusters and bring strength to sections. And, it's not that somebody wanted you to go to the second floor, it's just that the women's floor will be the second one.
I appreciate that, but for a brand, a new brand in the coming up, I think visibility was very important. We did great numbers in Select City Walk, being the best mall that time in Delhi. And that gave us the strength to open 9 more stores all over India. We were present at Palladium also, and we did great numbers everywhere. But the decision to move completely to online was seeing the penetration. There was somewhere sustainability, the growth for 9 stores had been really fast. We really clocked in the 9 stores in initially 3-4 years. And we decided that, online, there is a lot of evolution that is happening in the online sector. The penetration is great. I couldn't have ever thought of opening a store in Jammu and Kashmir, being single-handedly handling the business. So today when we see orders coming from every part of India, internationally, that gives us a great sense of satisfaction, and we see the repeat numbers coming in.
So just to give the audience a flavor, so the 9 stores had X turnover and now you have...
So now I could literally see a 10 times growth in my top line and bottom line. So that's the kind of numbers I'm seeing in online, and I'm so happy I made that decision.
Wow, that's a good one. Wonderful. So Pranav, from your point of view, I know you have lots of problems. Let's pick 3. And also you're a capital intensive business, plus a lot of moderated and licensed business. So if you can just touch on what problems you faced, which were government controlled, and what problems you faced, which was market or internal to you, like people or process or something like that. 3 in each.
So
I'm sorry, I'm just making it prescriptive. I know audience will want to know more, so they can engage with you later.
Sure.
But just let's keep it brief so that we can cover more.
I'll take this question for the risk point of view or the things to be taken care of. I'll take as a two-angle scenario. One is the outside world and one is the inside world. So there is a tendency always that when we start working on the business model, we chalk out the business plan. We always try to show up the high numbers or high revenues or high growth trajectories for the people who are involved with.
2-3 points.
And there is a tendency that once we start off, it's likely that the scenario can derail from the plan what you made up. So you need to be extremely cautious when you make a business plan. It's better to be, be reasonable in terms of numbers and trajectories or growth path what you're looking at. So that is something which we learn during the course of action, that better to have the reasonable growth plan rather than having the more ambitious things. Because if you break from there, it is very difficult to come out with the action plan as a course corrective action or something. When you talk about the outside world, I mean, similar to other brands, we also encounter with a dealership process where we need to appoint dealers from across India. And initially we thought that let's go to established players. And as some of them have already shared, there is an acceptability issue. So when you are a new brand in the market, the established players will have a lot of questions in terms of whether this brand will succeeded or not, or what will be the response from the market and all. So having seen these issues initial period where the acceptability is not there, we change the plan. We try to understand the young entrepreneurs who were not able to associate with the big brands because where there are X, Y, Z factors and they could not qualify the criteria. But they had a very high level of passion to work on the automobile sector, to be with some brands, to grow with them. And we started approaching those kind of people who have a zeal and passion to work with us. And that plan worked. So plan A when didn't work, we went into plan B and the plan B worked. So in a very short span, we could expand to 10 cities. And we also adopted the model which is different from the other brands. Like we have appointed one agency for one entire city. This has given the confidence to the strategic partners coming with us, which has helped us expanding the network quite fast. When it comes to regulatory area, the government compliances is very, very stringent and it directly impacts in our sector. For example, if I touch upon when we bring the CKD from outside India, so there is a custom duty imposition is there. And recently what happens in February, government suddenly increased the custom duty from 10% to 28%. So entire calculation was there for the market penetration or price position, everything. It just got a hit.
You should have taken help of Trump.
In fact, it was like this. Though Trump pressurized India to reduce the duties for CBUs, and Mr. Modi played very wisely, so he reduced that and he increased the custom duty for CKDs. So we get the hit according to that. So
we'll not let you be Trump. But Sohrab, I just got a spell check done on my pronunciation. I hope it's fine now.
Yeah, absolutely.
If you can take us through.
Yeah, so I'll tell you quickly. Look, there are 3-4 things that have really helped me, and they are, well, I can say they're a little out of the box, and you may not agree with them, but they've worked for me. So what I could tell you, and that was my learning. So I go a lot by gut feel. I don't do too much research work on the product. My thinking is very simple, that if it works between 3 friends and 3 friends are okay with the product, there's no need to call everybody and do focus groups, blah, 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 especially when you're starting up. And the reason for this is I did this once, and we did a food tasting and there were some 10 people. So the first guy said something, second guy said nearly the same thing, third guy, by the time it came to the 5th guy, he didn't know what to say. So he started saying something which was absolutely detrimental.
So you're saying stop at 4?
I'm saying if you're happy, you don't have to. This is what has worked for me. Because the more I did this focus groups, I kept getting wrong information here. So that is one thing. So go by your gut feel because you started a business and that's your belief. So go by that. That's very important. Second mistake I made was that a couple of people I chose in my business, they wanted to become entrepreneurs. Now, the thing is, there can only be one entrepreneur in your team. So if I'm the entrepreneur, then you don't need entrepreneurs on your team. What you actually need are people who want to work with you and they want to grow in the organization. That's the mistake I made, and that was a big mistake. So that's something which is very important.
Are you saying don't make partners or don't make independent opinion makers?
No. There should be one guy responsible, but after that, when you hire somebody during execution, there should be a professional on board. It shouldn't be, you shouldn't get an entrepreneur who's got dreams of doing his own places. So that's a problem. And my thing lastly would be to just be aggressive. We all get caught up in systems and processes. My understanding of systems and processes are, if they're good enough at that point of time, just go ahead. So I sincerely believe that if you're 80% ready, you should move. Because perfection is never achieved. You'll keep thinking about perfection, 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 but it really doesn't come. So you've got to move on. Don't keep building the blocks of the pyramid. You've got to build the pyramid also.
That's a good one. That's a good one to say that be ready to course correct and go in half ready rather than waiting for perfection.
Yeah, otherwise you'll just keep waiting. And the thing is, this systems process is a natural extension. As and when you're progressing, they'll come. It's not rocket science. There will be somebody who will be ready to execute them.
You know, half of the guys who are not doing entrepreneurship think it's rocket science, including me. So very clearly there is a lot of rocket science which you all do, and that's what we are trying to learn from. So if I can, Ashwin, just tell us about a couple of your mistakes.
I'll tell you about a couple of problems and dilemmas that we have faced while starting up.
As long as it is 3, I'm fine.
Yes. One of them is that the acceptance of the product was a major problem for us when we first started, because people didn't know what we were giving them. So we had
they didn't know how thick was thick.
They
could have given them solid and got away with it.
So we had a vision of bringing the best quality shakes to the customer to make sure that they're happy. But until they even tried it, they didn't know that this is something that they could expect. So it really took a lot of time for us to break into the market and to make people try the product and accept that, you know, this is a really premium shake and let's pay a premium for it. So the kind of creation of the market actually took some time for us, which was a small hiccup, you could say. And as you were saying earlier, when you start up, there are a lot of opportunities across. So you always have to make sure that whatever vision you have for the company is what you're sticking with. There is a core focus that you need to have. And we came into the market with the belief that we want to bring shakes to as many people as possible. And right now, definitely we've made some head through with respect to the journey, but definitely we've not reached the destination. So we have to keep pushing towards not losing focus, because that is something that can easily happen when you have a lot of opportunities. Would you want to get into food? Would you want to get into ice creams? Would you want to get into something else? I mean, until we are at a position where we are everywhere and people are already knowing us for what we are, I think that's when we will have to focus on something else. So dilemmas like these keep happening, and you will always understand.
Those are business dilemmas, right?
Business dilemmas, but definitely for a person, as you were saying, it's a lifestyle problem. When you're an entrepreneur, you obviously reflect what the company wants to do. And it's what you learn in textbooks is not the same thing what you see across. And
fair point. That's why it's rocket science. So Sagar, what's your view on?
See, I personally feel as an entrepreneur, when you start, you primarily don't make mistakes, you learn. And after learning, if you repeat that, then it's a mistake.
Okay.
So
that is a good one.
Yeah.
First mistake, maaf.
Yeah, maaf. Because see, you're learning is trial error. I mean, things will only click when you're a first-time entrepreneur. It'll click with trial and error, and you have to give.
The only thing, Sagar, is that your mistakes were one plate of momos, and his mistake is he was telling me $6 million.
Not really one plate of momo. It's to do with the capex, with the store, with the kind of TG, with the location.
No, again, even if it is a store, it's between a 10 lakh rupee to a crore.
Yeah.
$6 million.
Like I said,
it's an India and a US story. You don't know when you get trumped.
That's why the valuations are higher, because the traction is higher in that kind of business.
So what are 2 things you will tell them not to do?
So basically, I'll tell you what.
You tell them what not to do.
Yeah, so I'll tell you what not to do. Don't keep all the wealth to yourself. You need to learn how to share wealth. Okay. So it's not about how much of the pie you own, it's about how big the pie is. So I learned not doing things.
That's a good one. That's a very good one.
I learned not doing things by all by myself. If अगर मैं ही सब काम करूंगा तो मेरे बाकी बंदे क्या काम करेंगे, मैं टीम क्या बनाऊंगा, और बिना टीम का मेरा ब्रांड क्या बनेगा, right? So I got in a third co-founder 3 years ago. He's sitting here, Rahman. I mean, I got him 3 years ago, and I think the best decision of my life, because when you grow at a rapid pace, you can't do everything. Today I have professionals in my company who are better than me, and that's what I want. I don't want to be the best. I want others to be the best to make my brand the best. So the biggest learning has been to put your brand above yourself. And always do that, so learn to share wealth. That's how you'll make wealth. Today the chef who joined me at a 3,000 rupees part-time salary, his daughter goes to an English medium school. He has a house to himself. He draws a salary of over 1.5 lakhs a month. He's not even educated. He's not a corporate chef. So what I learned is, not to do things the way others treat it. I think have your own course, have your own journey. Secondly, what also I would want to say is that, we talk a lot about systems, about SOPs, about funding, etc. But what I've actually learned is timing really matters, Timing, even if you play cricket, you have to time the ball well. Timing really matters. So if you're raising funding, you have to raise it at the right time. You have to be funding ready. If you're making systems, you can only make systems if you have volumes, okay? I see a lot of startups talking a lot about back-end systems. What will you do with it if you can't have revenue, if you don't have top line, if you don't have sales, if you don't have customers? What will your systems do? They'll just lay behind and hatch eggs. So you need to have sales happening, product acceptability happening. So the initial thing that you should do is focus on your product, on your service. Once traction starts happening, when you have consumers, you have volumes, you can work on the systems at the back end.
Business in and then shape the business into perfect.
Absolutely, absolutely. I mean, I meet so many startups, entrepreneurs who want to get everything perfect on day one. You can't do that. I mean, you are learning, and with learning you change. I mean, you have to reinvent yourself. For us, for a one store system, very different. For 10, it was very different. For 50, very different. For 100, very different. So you have to give your business that evolution to grow.
Great. So I think it's a great sense, and I thought that a lot of learning, but it's so varied, many of you may not assimilate it. But one thing which everyone will like is our next section. It's on funding, and we were discussing how to go about it, because funding for a startup or a new company continues all through the journey. It's like, if you see, even now, after 15 years, people will be raising funds and raising funds. So for a startup, there are a few questions we had in our mind, and I thought we'll target it differently. The main question we thought was, when does a startup require funds, and who do you take it from, and how much do you take? Basic questions, not rocket science. Unless you are somebody who makes a business with other people's money, whenever you take money, you have to give something in return, and these are the three questions which we thought will be what you will want to know from their journey. But what came out interestingly was that a lot of them are self-funded, and I broke it into two sections. So we'll do the self-funded sections first, which is literally to the right of me, and then we will do the rest. So let's start with the self-funding section, and Sohrab, if you can take it first, because you have some interesting takes. You don't need money and you still take money. So,
look, money is always welcome if it's coming. But if you don't need money, then it better come into your pockets. And I'm a firm believer of that. You worked hard. And I feel, look, we are lucky that we are self-funded. We created a company where we were able to have excellent, I would say, internal accruals. So we don't really need the funding. And for me, funding would be the last straw. Unless, of course, it's a funding that you want to go in for, which is called a secondary funding. And I do believe that secondary funding is
So the
important.
question I have to ask you, and I wanted to shock you on the stage itself, because I didn't want you to get complacent giving me stories. So when you said that you set out in the journey and immediately did many stores, how much money did you put on the table? Because you said it was not 30,000, so I know it must be at least 31,000 plus.
No, we started with 2 crores. So
that is a huge amount of funding. What prompted you to think that I'll put in an idea and put in 2 crores and wait for it to self-generate funds? And 2 crores itself, I mean, it's a huge amount.
Not really.
Why 2? Why not 1?
No, it couldn't start with 1. Also, you must understand that I'm at a different stage in life. So I started this business when I was 40. So all three of us.
You're looking younger now.
I should have got rid of my beard. I mean, I made a mistake coming here with all these young boys. But so the thing is that it's very important when you start a business. We require that much money because I did not want to start with 1 outlet. The idea was to quickly scale up the business, and like I said, the aggressive approach always has helped me.
So how many outlets you started with?
So we started with 5 outlets.
In same city?
Yeah, same city, but in the very good places, in the malls. So that's when we started our business.
So then I'll take, I know this is where I'm deviating from the topic why they are here, but what did you choose? A good location or a low rent?
Low rental is a disaster. So I would never choose a location low rental. Always the best location needs to be chosen. And primarily for the kind of business that we were in, a little more aspirational product, the malls work the best. So we always went with malls.
So how were you confident that each store will be operationally profitable before you even started? How did you get the pricing right? How did you, I mean, Did you think that there was no risk in your first 5 stores?
Of course, there was a risk. The thing is that whenever you create a business plan, you make it a little conservative, okay? There is no point heading into a business plan trying to prove that these numbers are going to work out for you. And you join many dots. The thing is that we were able to make a product, an aspirational product, and we had the first mover advantage. That is why we were very confident. Again, the first mover advantage was not something which was absolutely unknown. It was not molecular gastronomy, or it wasn't something which was way out, right? Though it was a first mover advantage, but it consisted of a product that everybody knew. So we were fairly confident. First thing we did was that we wanted to make sure the ROIs are quick in this case, so we wanted to keep it very, very low cost. Unfortunately, in malls, there's security deposit.
Cost. I must be in some other business.
No, that is not the store cost, no.
Okay.
Yeah, so 2 crores is overall. So if you,
talking about the back
there's
end
office, then you needed to, you know. So we did all of that. That is where the money went. But if you ask me how much money was the store taking, that was about 18 to 20 lakhs at that point of time. Yeah, each, which was perfect. Because, you know, whenever I've done restaurants, and I've done nightclubs, well, not nightclubs, where recovery was much faster, but restaurants, the recovery has been very, very slow. So we wanted to do an aspirational product. We wanted to keep it at a higher price so that if 100 ticket sizes are there, you're still able to make money. And the recovery of money is quick. So in fact, in certain places, we were doing an EBITDA break, you know, about in 4 months. Absolutely. So, so that's what really helped us.
Yeah. So the next question to Ashwin. And you told us, I think, that you're not taking external funding and it's all through internal accruals. Do you think you did the right thing?
Absolutely. I mean, see, we are where we are because of what has happened in the past. I mean, I don't have any
but the question is, you could have been like sort of 100 by pumping in more money.
As he said, he started in 2015, where we started in 2013 December. So in the 1 year, the market has actually changed a lot. So with us starting one outlet in Hyderabad, back then there was actually nobody selling shakes for 150 rupees. But within 1 year, when we started opening our second outlet with the vision of expanding much more, making the model scalable and ensuring that, see, I mean, as I told you, there is definitely a mindset in taking decisions when you're self-funded because you risk more, right? So you would obviously want to spend as little as possible and try to maximize the ROIs that you have.
So today, if you want to think that I want to open 300 stores, will you take funding? Will you not take funding?
For 300 stores, definitely we wouldn't want to put up 300 stores. We would like to franchise more number of outlets and put.
So you want to put other people's money, but not.
No, I wouldn't say that. We would, if we raise money, we would like to put up some outlets of our own, which will enable organic growth, because that is what we've always done. We always relied on word of mouth publicity and organic growth of outlets. It's not like I could put up 500 outlets or something like that. We wanted more number of people to get on board with generating more number of entrepreneurs, because most of the franchisee owners that we have are the first-time business holders. They're aged between 20 to 25 years or maximum 30 years.
So are you not taking an entrepreneurial risk that each of these guys may individually fail for other reasons?
So that is one of the mistakes which I had missed conveying earlier. So initially we have definitely made mistakes as choosing franchisee partners who are willing to do business. But later on we realized that that's not the only quality we should be looking for. We should also be looking at people who would want to do business in the way you would like to do them. Because it's a franchisee at the end of the day, and our job is to make sure that the ease of business of a franchisee is as easiest as possible. They shouldn't go through the hurdles that we have gone through. They don't have to walk my journey of the last 5 years. If anybody wants to start an outlet of the company, it has to be done in the next 1.5 months. That's, I mean, as long as we get the real estate space, of course. But that's how we would like to do it, and because of we come from a self-funded thing, we still value money as it is our own.
Everybody values money. Yeah. Sohrab just said that he loves the money coming his way.
Absolutely. So even when we spend money, we always look at maximizing the ROI. So tomorrow it might be, you might actually be busy to not look at the ROI, because as you said, let's not always wait for making it perfect, but you would like to take things forward. That's definitely true. Yeah. But then again, you have to also think about the franchisee's money and make sure that, see, it's all individuals who are comprising of the whole company, and that is the core principles in which we thought, so that we can generate.
So these 42 are your own, but going forward you will do half franchisee, half your own stores.
We would still keep enabling more number of franchises as well. It is only to create awareness. It is only to create awareness that there is a profitable and successful proven business model like the ThickShake factory, which is scalable and which is expandable, which is widely accepted across the country and across the globe as well. So that is what we are mainly looking at.
So Sagar, the question again on the funding for you. Again, self-funded, with other people's money. You know, I remember you telling me the first store was somebody did the flooring, somebody did the ceiling, you did a shop and you made money out of it. But that's not my question for you. Why did you not go for funding but for a partner? Because funding would also have given you the same money and still retained a lot of ownership with you, right? So what's the difference between increasing to 3 partners?
So I'll tell you what, for me, it was all about value. I mean, equity is not cheap, right? It's quite expensive. And if you value equity, you will value the equity of your investors. So I think having more hands always works. So when me and Vinod began, it was like not 1 + 1, 2 + 1 + 1 was 11, okay? And when I said that, you know, somebody else did the flooring, it was more about Spencer's doing the flooring for you, etc. But ideally, the first 43 stores were plowing back profits. So we save money from 2, open 4, save money from 4, open 6. So the business was making money. Now, when your customers become your biggest investors, that means you're on the right track, right? And when you do well, everyone follows you, everyone wants to give you money. So as long as you're doing well in business, money will come in. There's nothing stopping money. I'm stopping money coming in. What is important is when to raise and at the right time to raise.
I think great music, but you know, a lot of guys must be struggling to even raise money.
Yeah, very true, very true. It's how business works, you know, as long as you do well, you are funded, and that is why you need to choose the right partner with the right mindset, who will actually back you when things are bad. So like, I'll give you a small example. When we raised our first round of Series B recently, we had 3 term sheets, we had a higher valuation, but we chose a partner who understood retail, who had a track record of backing another retail partner who had failed and bounced back. So what you require as an entrepreneur is you require security, but more importantly, you require someone to be patient and someone to stand behind you and back you.
So choosing the right money is important.
Very important. Very
and
important.
What else
choosing
comes
the right
along
money,
with
the right partner, and also with the money, you also need to ensure what kind of hold they hold in the entire financial community, how they can connect you using their networks.
So the second question, I think, and I'll end the question for this self-funded trip here. How much money to take?
So again, it's about your business dynamics and how ready you are. So like in our kind of business, we can open 3 stores every month without raising money. You know, the cash flows are so strong. But we have the potential now and the team now to open 10 stores every month. So, you know, I'm tripling my growth. So it's opportunity versus cost, okay? And again, raising money is not just equity. You can also go for debt. So like right now we are again raising, but we're raising debt because that is cheaper than equity. So it's about raising as much as you can have the appetite to eat. It's like if you are hungry, you know, to have 1 bowl of rice, you rather have 1 bowl of rice rather than taking 2 and then wasting the meal, you know. So it's very important to take as much as you can digest, as much as you can absorb, and ensure that you have the team backing it. Because like I said, funding is like an ammunition. Once the money comes in, you have to really go fast. You have to use the money in the right manner, and you have to scale up. You have to give your investors return, right? So it's about absorbing the right amount of money. If you're taking debt, you have to know that your cash flows are strong. You can pay the interest, you can pay the principal. It's all calculations. It's all maths. I think as long as you're an entrepreneur and you know your business, you know how to take and when to take. You should not get overexcited, should not get too tempted, because ultimately it's not a short-term thing, it's a long-term thing, right?
Perfect. So I think you can shift. Yeah, please. Sohrab has to leave. I think he had a hard stop at 4, so I'll just let him go. Thank you, Sohrab. See you. Good that you finished your section of educating us. Those who want to reach Sohrab can just connect with Mapic, they'll link you to him. Now coming back to the same question, and I'll start with maybe Nikhil and then go to Siddharth. How much money do you need to take from, when you do fundraise, how much money you need to take? And why do you need money more than what is needed?
So, by the way, we are self-funded, and having been in the business for long enough, our internal accruals have helped us grow where we are and we are today. And like Sagar rightly said, I think the most expensive form of money is equity. So if you can manage to grow the business and your business does not need equity, I think you should stay away from funding, because what's important, and I realize this because, you know, people came and approached us and wanting to fund us. The kind of expectations they have from the business and the entrepreneur is very different. And if you go by, you know, what you read in the papers, you know, the kind of money that is being raised and the amount of money that's available, and you get tempted and, you know, get into this trap at a point when the business cannot deliver or, you know, grow to the extent to which the investors are happy, I think it will lead to unnecessary stress. It will lead to probably, going down the wrong path only to show top line.
So basically, you're saying that take money, but before you take money, agree on what you will deliver, and it should be cautious rather than.
No, I'm saying take money if your business really needs it. That's what I'm trying to say. And once you say that you're going to take money, you need to make sure that you have your investors and yourself on the right
in
path.
business, do you think the business plans are so foolproof that you will always be on target, year on year, month on month?
I'm not saying that we will always be on target, but at least 80% of the time you need to get it right. So, in the hunger for top line, you may go down the wrong path, and that's what I'm trying to say.
Perfect. Siddharth, your journey has been different, and you have a different view on how to grow and how to raise funds and when to raise funds and who to raise funds from.
Sure.
That is going to be interesting for them because I know I've been part of I've been a part of that journey, but I'm sure they'll learn a lot.
Sure. So we were a self-funded business all the way till 2007. I think.
And at that point of time, you were 5 stores or something.
We were around 25 stores by then, 25 stores. And that whole retail expansion was happening. And a lot of properties were coming in, a lot of real estate was coming in. And I'm a first generation entrepreneur. My father was in the Indian Navy. So we didn't really have family assets that I could fall back on. And it's a family business. Family was very constrained on taking debt. I think debt is a much cheaper form of financing. So that's when, and expansion in retail is a very capital intensive business. And I think you've got to realize that when you decide to expand in retail. We raised 12 crores of primary at that point of time. So it's the same thing. I mean, you don't have to go and dilute 25% of your company. You can dilute a smaller percent of the company, but very, very important to be adequately funded on equity for retail capital, retail expansion. You can't predict everything.
So you're saying if you're a retailer, better be funded with equity than debt?
I think adequately funded with equity. I mean, there will always be a mix. But I think I'll share the example was in 2007 when we were pretty much debt free and I raised capital. Most bankers would tell me that raise capital, raise debt, add another 40 stores, get higher run rate, get higher turnover, get all those things and then dilute. We went ahead and raised at that point of time. And 2008, everyone knows what happened to the financial markets. So if I was raising debt and in 2008 I was hoping to raise equity, it was never going to come. So I think it's also a point of, fortunately the business does well and it did well. But if it doesn't do well and you got to pay that debt off and you don't have the equity funding, it can actually lead to a lot of other problems in the business.
What other problems? I see, because I just want those who are here, entrepreneurs, to know some problems and go away.
No, I mean, it can lead to the death of the business, clearly. If you can't fund your debt, and today the way the banks are pulling back, it can lead to banks making you change your business model. Models need 2 months, 2 years, 3 years, 4 years sometimes to sustain. And retail is a capital intensive business. So it has to be capital funded, equity funded to some point.
Yeah. So coming back to Pranav, how did you, so one part of the journey is finding...
I think I'll touch on one more part.
Yeah, please, go ahead.
And who to take it from is also an important...
yes, that's interesting. Not part. From me, anybody else here.
Yeah, I know one of the colleagues was mentioning that as a startup, you don't have choice. And I think that's a situation many people may face. But very important.
If you have a choice, who to take it from?
Yeah, I think it's a partner. You're onboarding a partner. You've got to see, I think the chemistry's got to work. You've got to think alike. You've got to be able to gel with the person first. I think then gel at a business plan level. Very important to see the credibility of the fund, of the person who's running that fund, or who you are going to be interacting with. These are all things that really should have the right amount of time spent on due diligence. I don't think the person who's paying you the highest price is important. Always structure it as pure equity, especially if you're a small business, because you want an equity partner to come in and share the risk. You might get 20% higher valuation and then you run yourself into a structured format. And you've always got to think of if things don't work, that's when you're getting an equity partner. If you come in and project a growth and you hit everything, everyone will be a great partner. But when things get tough, are they willing to stand in there for 2 years and slog it out along with you?
Yeah. So Pranav, running and starting a rollout with franchise partners or partners who are distributors is one form of other people's money, so you pick them up. But what about the initial money where you put the original money and you have to raise it from partners? You had some bad experiences or moderately mixed experiences. What's your learning from those?
Yeah, so couple of points. So when we reach to the stage where we're going to sell first bike in the market, we already invested almost $3 to $4 million so far, and we have not yet sold the single bike at this point of time. So yes, there is a different format altogether which we run into. But couple of points what he has mentioned, I will add to that. The finding the partner is extremely important because first of all, in this stage, initial stage, you don't have choice to get the debt funding. Because when you go to banks, they ask a lot of things, collaterals and all these things which you may not be able to offer. So that is big no for you. Rather, even if you wish, you can't have that, first of all. Second thing, when you go for equity, is more like a marriage with the other partner. So no matter how much money you are raising, but if there is no synergy between two sides, you can fall into a big trap. And rather than getting into the business or using the money in right spirit of business, you actually start falling into a different trap altogether. So you start fighting on different direction. There will be ego clash can come up, which will altogether take your business plan entirely from your original plan to a different direction. So we had some issues. We somehow fortunately resolved those issues and we come back to the track also. So it's important you keep these factors in mind. And most important thing is, which I've been telling with our group from day one, when you go for horse racing, if you are racing, participant in the race, you typically put the money on the jockey and not on the horse. So it's important who is driving the business, he should be fully confident about what you are showing to them. So business plan has to be very, very fundamental. You don't overcommit and underperform, rather you make a very, very conservative scenario.
I just do not understand the jockey and the horse thing. So you put money on the jockey, which means that I take money from somebody, understanding, forget a bit about what money and what structure, but look at the person and see whether he understands the problem.
Absolutely. So it's like when you find the prospects for putting the money on your business model, the product comes next. Of course, it is given that product has to be sellable. Otherwise, there is nobody is going to talk to you. But then the person or people who are driving from the day one, those should be confident enough so that in a nutshell, I say people invest money on the people rather than the product. So you get confident with the investors unless you have that striking balance between them.
That's exactly where Siddharth was mentioning that the partner is more important than the money.
Absolutely. So if you fall into a trap where you are just in the hurry to get the money, but then you don't look into those finer points to whom you are tying up with, then you actually fall into big trouble in next couple of months down the line. And the entire business plan can derail. It's just a piece of paper while you get into a different fights altogether rather than utilizing the money into the right fashion.
So finally, Natasha, if you want to add anything or if you want to ask them any questions.
So I would like to add that the capital infused initially really helps a brand to build its positioning, to look at what your next plans will. But when you have a situation where your parent company is now parting ways, like many of us have faced, like he mentioned, Pranav, that there was a split in promoters and so when a situation like that happens, you also have to sometimes change your model and look at how you can sustain your brand with limited funds. So
what you're saying is have a plan B with lesser money.
Always have a plan B. First, obviously your product, you're confident about your product. Your product will do, it will talk for itself. But at the same time, to sustain your brand, your company with limited funds, you always have to have a plan B in place.
Perfect. So I think we're just maybe close to ending the session. We covered the products, multiple products. It was difficult getting so many different growth opportunities. And we covered the problems and we covered the money part of it. Over to you, audience, for a couple of questions so that and then maybe we'll take it offline because I know we have exactly 5 more minutes. So if you have any questions, please. And be specific who you want to answer because different categories we are sitting with. Great. That's lovely. When you go through a session and there are no questions, you feel that either you did everything right or everything went as a bouncer. And let's assume that everything went right, because I'm going back learning a lot. And thank you, panelists, for being a great panel. And very open, just to be able to express your mistakes on a public stage is itself a big thing. All of you are doing great. I hope you do continue to do better. Thank you very much, the audience, for being patient.
Thank you.